Angelus Foundation is the philanthropic arm of Angelus Investors. This is a foundation that is based out of Chicago. It's a nonprofit organization that provides socioeconomic empowerment and programming. The foundation is dedicated to providing resources to three types of prospects: prospective investors, including webinars on investment fundamentals, due diligence, and risk assessment, like this webinar. Second, community members, and third, startup funders. So welcome. Today I have with me, and I have the pleasure to be joined by Whitney Haring-Smith. He is managing partner at Anzu Partners, and he brings deep experience across venture investing, board leadership, company building, and a particular focus on industrial and breakthrough technology companies. Also, we have Carlos Antequera, and I'm also excited to welcome him. He's co-founder and CEO of Novel Capital. Carlos is a second-time founder, investor, and a Kaufman Fellow who works closely with B2B SaaS companies and capital strategy and growth. Today, we will be talking about understanding startup financials. What are the key metrics, KPIs, and red flags that you need to look when it comes to investing for the side of the investors and for founders? Hey, what are the metrics and KPIs I need to consider when I want to raise capital and present to investors? Thank you for joining us. So,
For having us.
thank you, Carlos and Whitney. Carlos, to start us off, I would like to begin with the founder and the capital strategy perspective. You work closely with SaaS, as I mentioned, making real decisions around growth, cash flow, and funding. So you have a very practical lens on what healthy startup financials actually look like. So my first question, Carlos, to you is when you first look at a SaaS company or a startup or whatever company you're looking at, which 3 to 5 metrics do you prioritize immediately? What are those go-to view that you have? Is it ARR, net revenue retention, CAC payback? What are those 3 to 5 metrics and why?
Yeah. Thank you again, Jeshua, and might be helpful to give our audience a little bit of background on Novel Capital because we're a different capital provider than what you normally are used to. So Novel Capital is a fintech lender. We created a loan specifically for tech startups. And so from that perspective, we look at companies in a little bit different way that what you think your traditional equity provider might look like, that your traditional VC might look like. So the keys for us, we have a 2-year instrument, right, that we provide capital to the software company, approximately about 25% of the revenue, the trailing 12 months revenue that they have. And unlike VCs, we're expecting to get a return on 100% of our companies, right? So we're not looking for those 1 or 2 big unicorns, but we want our risk-adjusted return for those, for all the companies that we provide capital to. So that's one of the key differences. So from that perspective, the key elements that we look at is the revenue. We only work with post-revenue companies, specifically $500,000 in revenue in the low end, up to $10 million in revenue. So revenue is the key for us. We don't only look for, also another difference, we not only look for ARR, recurring revenue is good, but we know that the majority of tech companies have services, have usability fees. There's just a mix there. There are very few of those clean MRR companies across the board. So revenue is super important for us. The second element that we look at is growth. Again, that's another area of difference. We want growth, but it doesn't have to be your 100+% year-over-year growth. We're looking for growth between 10% to 50%. And so we want some level of growth. Consistency is more important to us. So those are some of the key elements. And one element that is very important for us, and I think would be very important for a lot of founders, but in many cases we don't find that, is obviously, the classic metric is net revenue retention, and that's one of the ways in which you can look at growth. But we also look very carefully at customer growth, customer composition. For us, it's a very important marker of can the founders sell and sell consistently? Have they figured out who their customer is? and a way to consistently acquire new logos in a way. And when we look at net actually logo retention, so on the other side is right, if your logos are not growing, it means that there is a lot of churn, right? And overall, if you look at that complete picture, then you should be able um, to have a healthy growth in terms of logos, but also connected to your revenue. So those are some of the key things that we look at in particular for our case. But I think they would align well with a lot of founders that are looking to grow a healthy business.
Amazing. Very very particular how you look at these deals. Uh, Whitney, Carlos is grounding us into the operating metrics, and these operating metrics are always and are often what shapes a company and how it is managed day by day. I would love to get your perspective a little bit more from the VC side, because investors in different types take a different look into the same numbers, but interpret it a little bit different depending on quality and durability, specifically. So, Within my question to you is: when you're evaluating a startup, which specific metrics tell you that the growth is actually durable and it's not just impressive on paper, right? We have great ideas. We have sometimes one or two metrics that will be really highlighted by the founders, but you really need to take a deeper look into it. So curious on your opinion.
Yeah. Thank you so much, and thank you for hosting this webinar. I think this is such an important discussion to help provide a perspective of what it looks like from different sides of the table on a discussion that can make a big difference for the future of a company. I will say one of the questions that we often ask early in a process, and it can be one of the most awkward discussions, is to simply say, if you're pitching us for Series A or Series B, so show us the pitch deck from your last round. Show us the pitch deck from Series Seed or Series A. And when we talk about durability, durability can be a lot of different factors, right? It can be about the team's consistency. It can be about the commercial objectives consistency. It can be about whether we regularly hit our forecast or not. There are situations in which we look at companies that are not growing consistent with sort of the classic magic SaaS metrics like a rule of 40 or others, but it is important to us that they are able to reasonably achieve their own plans, that they know where they are in their own growth trajectory, and that they have a reasonable control over their own business. So that's one element that I think can be very helpful, and it can be very credibility enhancing for companies as they approach VCs to say, we will tell you what we told the last VCs who invested, and we achieved with their capital what we told them we would achieve. And so that can be very validating that when we take your capital, we will do what we say we are going to do with that capital. So I think that's one high level approach. And then you start to get into some of the elements that Carlos highlighted that can vary by category, right? So we at Anzu focus in industrial and life science. Those can look somewhat different. Life science companies don't always have a lot of revenue, but are moving through clinical stages. And it's important that they're moving through those clinical stages on the timelines that they projected and on the budgets. In industrial businesses, there can often be a long sales cycle. And so part of what we're looking to understand there is, where are you in the sales cycle with these customers? And those who have bought one and have already endured the first sales cycle, are they buying a second of whatever it is you're selling? Because a lot of customers in a long sales cycle can be very hard to measure. And then, of course, consumer, which we spend less time in, has a well-developed set of metrics that are important for durability, cohort analysis and similar. And there are times when we're able to look at our industrial companies, for example, where we sell hardware and we sell a consumable, and we can segment just the consumable portion and then treat it like a consumer business in order to do that kind of cohort analysis. So it depends a little bit which industry and which segment you're in, but reliably show us your last round's deck and where you are against that has always been an illuminating discussion for us.
That's very interesting, because when you think about it, when you review the deck that they previously used for seed or pre-seed, that tells you how they were thinking about growth and how they really did when they come back for Series A, B, or plus, right? And that's very very valuable and very important. Thank you for that point, Whitney. And that tells you, growth is important, but a company may be growing quickly, but not all growth is equal, right? And underlying some growth, you need to take a look into efficiency, and that might tell a different story, right? So, Carlos, to that point, I want to ask you, how do you use metrics like burn month multiple, CAC payback, and magic number to distinguish between efficient growth and growth that is becoming too expensive?
Yeah. On our case, actually, we don't look as closely to all those metrics. We definitely look at burn, and that's probably one of our biggest ones. In our particular case, again, we're normally providing companies with I'll call it a smaller amount in general that they would raise on a full equity round, right? So, and we have this conversation many times with founders that say, "Hey, I'm raising $2 million," and we say, "Well, if you have right now $2 million in revenue, we could provide you, let's say, 500,000 approximately." And we really get into the conversation of, okay, what is it that you're trying to accomplish? In many cases, they say, "Hey, I'm really trying to expand my sales team." And so when we go, well, if that's what you're trying to do and you're trying to expand sales and gain additional customers, maybe you could start with, right, just hire a couple of salespeople that will get you some revenue, that will increase your valuation, get you maybe in a better position to do that. You don't need 2 million to do that today, right? But in that conversation, then we get to the burn, right? If they are burning 200,000 a month, I could give you 500,000. The problem is it's going to last you 2 months and a half, and then you are back at the same place that you started. So the problem was not really, okay, I'm trying to grow. It's I'm trying to grow at any cost, or I'm trying to grow in a way that my revenue is not catching up, or my cost of customer acquisition is not the correct one, right? So although we don't get into those specific metrics, right, ultimately the problem sometimes is there, right? Is either I'm spending too much on the acquisition, or just my operations overall outside the acquisition are too expensive. And so so we look really carefully at burn and the burn trend as well. There are some cases in which, right, when you are in your R&D phase and you're getting out of that, sometimes it takes a little bit for that burn to decrease, but the trend has to go the right direction. If you're telling me a good story, a little bit to the point that Whitney was saying, right? Hey, you can tell a good story on your deck, you can tell a good story on your Excel, but if that story does not match, in our case in particular, the actual data from your previous 6-12 months, then I would say, well, that doesn't square, right? You're telling me you're trying to do this, but your numbers are going the other direction. Your burn is increasing. Therefore, it doesn't make sense. So something needs to change. Either you as a founder need to make the tough decisions to decrease your burn, or you're going to have a different way to fund your growth, or maybe you need to realign kind of on what your business model and the plan is.
You touch base into something that is very important, and it's the runway. We'll talk a little bit about it, but you also say like, hey, if you're raising capital, if you're burning that much capital and it's becoming too expensive, then you need to be careful, right? And Whitney, that naturally leads into the investor side on the same issue, because many companies can present as top line of growth. Hey, as Carlos will mention, I'll bring 3 more salespeople, and these are the amount of clients, but they're usually growing but also hiding weaknesses, and some of these weaknesses can be retention, margins, or even capital efficiency, which is what we're talking about and what Carlos was mentioning. So into these concerns, which metric mismatches tend to concern you the most with, and for example, is a strong revenue growth paired with weak gross margins, or high churn, or deteriorating cash efficiency? What are those metrics that concerns you?
Sure. I think there can be a range of times when it's hard to see through some of the metrics to how the underlying business operates. The one that I think is encountered most frequently is the difference between revenue and net revenue if you have somebody who has a distributor or a reseller relationship. So, for example, if you are functioning as somebody who's distributing other products even alongside your own, or you're functioning where you have an internal marketplace, whether that's an internal marketplace for designs in 3D printing or an internal marketplace for services in certain categories, you can end up in a situation where you've got extremely fast growth and it looks really good, but the underlying net revenue is just a fraction of this, right? You think about sort of how much does Amazon take home versus how much does the sellers take home? Well, the sellers have to take home something for the company itself to take home just a little bit. So that gap, I think, is one that often can be a mismatch and just lead to genuine miscommunication in the room, where somebody says, I have revenue of 10 million, and you say, well, then how can you possibly be burning any cash? And well, it turns out actually net revenue is 500,000 because they're only getting 5% on every order that's passing through their system. I think another component that can be confusing is are these compositions of revenue. And there you've really got a number of categories, right? One is classic one-time non-recurring engineering, typical in a early stage industrial project, can be typical in the pilot project of a software company where they say, I want to buy 3 months of service. I have no idea whether I'm going to buy it, and I have no obligation to continue after my 3-month pilot. All right, that's a true one time. On the other end of the spectrum, you can have things that auto-renew ad infinitum to infinity, and those are your classic monthly recurring, annual recurring, whether they are in the software space or whether in the services space. You're leasing out data center space, for example. And then you have some things that are in the middle, and they can be much harder to categorize and much harder to think through, which are really reoccurring situations where for example, that there's a strong aftermarket, right? You've distributed a number of pieces of hardware, but people need to buy replacement parts. Well, they're not on a permanent schedule to buy those replacement parts. But they are going to have to buy replacement parts if they used the product. And so those can be reoccurring components. And so when we start to look at what are these metrics and what are these metric mismatches, we try to look at things that indicate the durability and consistency of the use of the product, right? And now in software, we're trained that is daily active users or monthly active users. But in industrial context, that can often be not how many devices did you sell, but how many replacement parts did you sell? Because you'll never sell any replacement parts if people aren't using the system themselves. And so it's those sorts of underlying metrics that become quite important for understanding whether you have a durable business.
Yeah. And that'll add to the point that we made, the other area that we look closely, because sometimes of that differentiation between the net revenue and the gross revenue is the profit margin, right? That tries to get out of that and give you a clear picture. And to the other point that we made of the variety of revenues, the other thing we see, at least in our case, sounds like maybe a little bit, maybe in some cases earlier stage conversations that Whitney has, founders that go from one extreme of just being overly optimistic to others describing the revenue, other things that are not quite revenue, right? So somebody that signs a contract for X 100K and they say, well, that's my revenue. Well, that might be your ARR, but it's not actually revenue that's been booked. And so that's when we talk about revenue, that's what we talked about. And there are other founders that are even more aggressive, in which they'll count as revenue contracts that haven't been signed yet, that they feel super optimistic are going to be signed in the next few weeks, right? And many of those sometimes don't materialize. So on the investor side, I would say, if you don't want to have do a lot of work to be surprised later on those earlier conversations, try to get as clear as possible of when the founder is referring to revenue, that you both are talking about the same definition of revenue. That'll save you from some time and some surprises later.
Yeah, and I would echo that in the industrial and life science side. One of the challenges is how to characterize grant revenue or how to characterize research contract revenue.
Yeah.
And this comes up often, and they can be very large numbers. They can be millions of dollars. And the question is, was this a revenue that represents your future business? Are you going to be consistently selling research, or do you exist to get grants from the government? Or does it really represent a negative operating cost? Meaning they're just defraying some of my operating costs because I got a grant from my university, or I got a research contract from a strategic partner. And being sharp on which of those categories it really represents can be very important. And certainly for the sake of an investor trying to understand your business, breaking out that revenue line item into 2 or 3 items, and we say, no, these are the products I sold. This is what really represents my go-forward business. And yes, I have a very compelling technology, and I got a $5 million grant from the government to develop a potential diagnostic for cancer. But that's a grant. It's not me selling $5 million worth of diagnostics for cancer. It's a $5 million grant to develop that diagnostic. Being able to make that separation clear for investors can be very helpful.
Echoing this conversation, Carlos, one of the hardest things for founders is understanding which metrics matter the most. When they're trying to decide, okay, how do I finance my business, right? Is it I try and as Whitney was suggesting, is it a grant? Is it venture capital or non-dilutive capital, or what financial profile usually signals that a company is better suited for venture equity instead? So that's my question. What metrics make a company more attractive for either non-dilutive capital or for venture equity instead? What should they consider?
Yeah, I think there's a couple of ways to look at it, right? One from the investor, from the capital provider side, like in our case, like I said, for us, revenue is very important. If you don't have revenue, then we cannot provide you a loan. In our case, right? So there's a few metrics that we look at that. But I would say from the founder side, maybe it's the more interesting way to look at it, which is most founders, you know, I'll maybe put a little bit of the blame on the media, right? That made them just look at VC, or in some cases accelerators that teach you just to create a pitch for the VCs. I think very few cases they are taught, well, think about your capital strategy as a set of tools that you can have, and identifying what the best tool for your company, for your business model, and for where you are in your journey should be the exercise, right? In some cases, as Whitney was saying, hey, if you can get $5 million grant, that's not only totally non-dilutive and it lets you do the R&D, go for it, right? Not a lot of folks have that opportunity. And it takes some knowledge and some capability to be able to get those grants. The other thing I always tell founders is the cheapest form of capital you can get is revenue from your customers. If you can figure out how to sell and get money from your customers, that's the best capital you can get. Outside of that, I think it's determining a little bit where you are in your journey, right? If you and your product, if you have a heavy R&D product, if you are trying to build the next chipset to compete with NVIDIA, you probably have to get VC money, equity money. You're going to need a large amount of money just to get to a certain place in which you can generate revenue. But under many other circumstances, if you are doing some kind of software automation, and now with AI, you can be much more capital efficient. Maybe you need that R&D portion for a very small portion of your journey. And once you have taken out a lot of the risk on the product market fit and the product development, the R&D portion of your business, then maybe it makes sense to move to lower cost of capital that allows you to maintain more of the ownership, you and your early investors in any case, and really use more non-dilutive tools like the tools that we provide or similar tools. And one story that I get reminded when I think about this type of decision is there's a really good book called Lost and Founder, a story of I think it's called Rand Fisking, the name of the founder, that raised I think many millions of dollars to just end up at the many years in the journey just being so overly diluted that even though the company is producing hundreds of millions of revenue, he has such a small portion of the company for many years of work, right? Because he didn't plan early enough the amount of money that he's taking and when he's taking it. And so I am pretty sensitive to that and try to tell founders that there's no right or wrong capital. It is just is it the right or the wrong thing for you at a particular point of your journey, and that you got to make the right decision and educate yourself.
Picking up on that, I would say,
and that's very interesting. And Carlos, you mentioned something that I took it as metrics are not just a scorecard, right? They shape what type of future a company can support, right? And that's especially relevant when you think about stage. What I want to talk about, something that Whitney in the past mentioned in this conversation, is that it's different what you look at when it's in seed. That's why you're asking back for those pitch decks. and the metrics that you look in Series A or later, right? So, Whitney, how should investors change the metrics they prioritize as a company matures, right? Because it's very different what you look at when it's a seed than what they should look at when it's in Series A.
Yeah. I think, it does naturally evolve where you're having a discussion where in seed, you may not care about gross margins, right? It's not possible to make the product in enough volume to get to the gross margins that represent your long-term goal, but you do care about getting to $1 of revenue, right? I mean, the reality is there's a night and day difference, and it is not a $1 difference between companies that have never sold a product for revenue and companies that have sold a product for revenue. And then as companies mature, you go from that moment where it's 0 to 1 on revenue to ultimately talking about when you're going to be profitable as a business. And we often have this conversation particularly as companies get close, and we say, minus $1 of earnings to plus $1 of earnings, those are not $2 apart. Right? Those are a much bigger journey in terms of what it implies about the sustainability of your business and what kind of capital you'll be able to take going forward. And I want to pick up on something that Carlos highlighted about what is the right kind of capital, because I think he's highlighting something that's very important, which is, yes, VC is an available tool, but it's just one tool, right? There are revenue-based instruments, there are loans, there's inventory finance, there's equipment leasing, there's grants and non-dilutive funding. There's a wide range of tools, and often people need to think about it, or at least we encourage founders to think about it through not only what is a fit for the business you're building and what is available in the market, right? Building a system where you think you're going to build on bank debt, but you are not really viable for bank debt. It may well be the cheapest form of capital available, but if it's not available, it doesn't matter what price it is. And similarly, I think it's important for people to think about what the risks are when they take certain kinds of capital. And each form of capital comes with its own flavor. With venture capital, there are typically governance constraints that start to come into it. The phrase is often used, when you are running a business and you take venture capital, right? Your business becomes their business and their business becomes yours. Not only do you become partners, but you become partners on their timelines and need to start to consider what the objectives are of your shareholders. And shareholders and venture capitalists have a very specific fund metric and fund timeline driven set of objectives. That's how we earn as an asset class our right to deploy capital to founders. Similarly, if you take on bank debt, that may well be the cheapest form of capital, but it comes with the hardest timeline restrictions. Venture capital that owns equity or angel investors that own equity don't have they may have timeline expectations, but they don't have timeline restrictions. And there is no maturity on equity in traditional senses. And so thinking through not only what is my cost of capital, what's my available sources of capital, what's my need, and then what are the risks that I'm willing to take and the risks I'm simply not willing to take. Balancing those four can give you the right composition of capital for the business.
Yeah, that's very true, and it also varies, depending on the stage that you are, right? Because it's not similar when you're just started that you really need capital to make it happen, but when you're already growing and it's steady your growth, or if you have exponential growth, better, right? You may not need this capital, and that tells you a little bit about balanced growth ambitions, right? And because founders are often trying to balance growth ambitions with staying financially disciplined, right? How do I raise? Well, do I invest my money, right? Or do I have enough extend runway, or I keep my options open to it, right? So, Carlos, my question is, putting in investor perspective, when founders think about burn and runway, what related metrics do you think they should monitor more closely beyond just months of cash left, basically?
Yeah, in our case, that is a very important metric, right? Because we want businesses that have a path to profitability, that can see the light, if you will, at the end of the tunnel on that, even though today they might not be profitable. So again, the way we think about it is, because our instrument is a 2-year loan for these startups, is we want them to, within 2 years, without the expectation of necessarily raising equity, have a growth path and a manageable burn that they will get into a profitable state within that period generally. And so that for us is very important. So one of the elements that we look, like I was saying earlier, is the burn trend, right? It has to be coming down. It has to be, the other element, it has to be manageable, right? So what is the expense composition? If you have a variable expense, right, that gives you some flexibility. If it looks like if things get tough or you decide to accelerate your path to profitability, you can make cuts but still service your business, right? In the case of software, for example, and we talked earlier about profit margins, right? If your profit margins are very high and you have high recurring revenue, then you know that that revenue is going to come next year, even if you, let's say, get rid of your sales team, because the majority of your customers are going to be there. And if you are you have very slow churn, very small churn, then you know that the majority of those customers and that revenue are going to stay with you. So understanding that expense composition helps you understand quite a bit what the flexibility and optionality for the business is. So that's another important area to look at. And then again, that sales efficiency and capability, right? Is if you are efficient on your sales and your cost of sales is manageable, again, if you are successful and understand your customer and you have that ability to sell, you could theoretically get another salesperson maybe to kind of get you out of that burn faster. On the other hand, if you haven't shown that consistent ability to sell, you are limited, with your options. So that's one of the things we look at a lot as well.
Yeah, and that's very interesting because you bring a conversation into the discussion about financial discipline and how metrics should inform decision making and not just reporting, right? Some founders just see these metrics like, okay, I gotta report this to my investor, right? But that's very important is decision making, right? What will take me there? What's the path and so for sustainability, right? And that makes me want to discuss and end this conversation in how investors interpreted the story behind the numbers, right? And when founders present their financials, Whitney, what specific metrics do you think they often misinterpret, they overemphasize, or fail to contextualize properly for the investors? What are those specific things that investors should really pay attention to?
Yeah, I think the journey of a startup is volatile, right? It can go 100 different directions and it changes every day, and the discussion with investors can therefore be very challenging because while it might sound to the investors like every week that you meet with them, whether they're your board, whether they're your existing investors, whether they're prospective investors, and it may sound like, well, every week it sounds like you're telling me a different story. It helps to give people some grounding that you can stay consistent with. And so, based on some of the companies that we've worked with, one of the things that the most successful founders we've worked with have done is they've helped people to understand only one or two or maybe three scenarios of the future financing. And rather than just one, we often have conversations where a founder says, well, after this round, I won't need any more money. Well, that's great, but it's also built on the assumption that you are going to hit every sales metric, that every customer will renew, that the largest contracts in your pipeline will hit, et cetera. And so it's a perfectly fair thing to say, we intend for this to be the last round of financing, but it can be very challenging with investors when you come back to them 18 months later, having told them it was the last round of financing, and in fact, it's not. In fact, there's going to need to be one more round or two more rounds. And so grounding people in two or three sets of circumstances, if we hit our sales funnel and if we hit our sales pipeline, this is what it looks like, particularly if you can explain that growth tracks to your historical growth. That can be one of the elements that gives the most credibility to something that's built on a future growth trajectory. One of the other components that we often talk about when we try to understand really how close are we on the runway consideration is what happens if you only get renewals from your current customers, right? Are we out of the woods built on a new customer that we don't have the sale from yet? Or are we out of the woods and we're out of danger just based on getting renewals from the current customers, which is a much lower risk level? I would say that the third thing that people often, I think, I would challenge when we're talking about these up cases, and an exercise that we've done with companies that have very, very aggressive growth trajectories is particularly if they're in the middle to later stage, is we say, all right, you have an objective which is ambitious and laudable, right? We want founders who are ambitious. That's what venture capital is designed to fuel, are those ambitions. But where do those ambitions stack up compared to the most successful companies in your industry? Are you proposing to grow 5 times faster than a company has ever grown in your industry? Because that's where we start to see a real gap. And that's where I think it can be very helpful, to say, we intend to grow as fast as the best performers in our industry, but not necessarily much faster. And this can play out on the other side of the coin. We've had conversations with a couple of founders who are very financially disciplined, very focused on making sure that they are good stewards of their investors' capital. But we look at the growth and we say, actually, the best companies in your industry grow twice as fast. So what would it take for you to achieve that industry standard? So I think as you think about conversations with investors and creating consistency without, giving up the reality that companies have very different days, day to day and week to week, try to build 1, 2, or 3 credible scenarios, and then be able to come back to them and say, we're trending towards our up case, or we're trending towards our base case, and then make sure that up case and that base case are built around some objective core elements that are not as likely to move around, and that can really build a good, consistent dialogue with investors around financial scenarios.
Excellent. That's very interesting, and that's perfect to close our conversation and open it up for Q&A. I saw a question that matches that perfectly, and is to both of you. What matters? Juan is asking, what matters more, faster growth or more efficient growth? Which is something that Whitney just touched a little bit, but I wanna ask both. Carlos, you go first.
In our case, I would lean to the more efficient growth, right? But I would almost add another element, which is, and Whitney touched a little bit of on his last comment, is that consistent growth, right? If you can show that you can do this, that gives you a lot of points, because then the risk on execution goes much lower, right? You've already shown you can do that or grow at that rate, then it's easier to trust that you'll be able to continue to do that.
Yeah, I think often it's what growth is appropriate to your company, right? There are situations in which companies are in true land grabs. The winner is going to take all in their given market. They have to grow quickly. They know they're going to burn some capital to do it. They don't intend to do it forever, but it's appropriate to the moment that they're in. And then there are other situations in which I would say that people cannot control the capital market. They can't make themselves or their own business get acquired. They can't make the public markets allow them to go public, and it's important for them to have time. And in those scenarios, efficient growth is really important, or even just profitability and capital efficiency generally, even if you're experiencing a moment where it's really hard to find growth in the market. So I think this is where being able to articulate to your prospective investors or your current investors, this is the kind of growth that is appropriate for the moment we are in as a company and as an industry makes a huge difference.
Amazing. Martha now asks, what's one red flag in a startup financial deck that immediately stands out? Whitney, let's go with you first, as you have the tendency of asking for all their pitch decks from previous stages.
I'm sorry, you cut out for just one moment. Could you repeat that, Jeshua?
Sorry, no. Yes, the question is, what is one red flag in a startup financial deck that immediately stands out for you? I ask you first because you usually have the tendency of asking for their past decks on different stages.
Yeah, I think often there's a question of urgency, and this is, in fairness, this is a metric that is challenging, because often the question is, well, why do you need the capital right now? And people say, well, I sold $1 million worth of product in the last 3 months, or I sold $1 million worth of product since I launched, and I only launched 6 months ago. And there can be real challenges around, okay, this is potentially an urgent need for capital, and that explains why we're having this conversation, but it doesn't necessarily show that there's durability. The one that I particularly love to see are same customer growth, right? This customer that bought last year bought another unit this year. This customer that did 100 million or $100,000 of revenue with us is going to do $150,000 of revenue with us next year. That sort of same account growth is very encouraging, and probably one of the more credibility enhancing components when we start to think about, is this growth going to be durable? And are we, often if you're having a conversation with us, it's probably one of the first conversations, right? We don't have the ability to go back in time and have a multi-year relationship. So we have to look at the relationships you have had over the last several years, and those are hopefully with your customers. So looking at that consistent revenue over time from similar customers, very helpful.
Carlos, what about you on that?
Yeah, so again, our approach is a little bit different, in which we don't even look at pitch decks, right? And we are just looking at the data. So we are connecting directly, partly because we're not trusting what they're putting on a pitch deck. We're going directly to the data on their banking, on their financials, and we're looking at that data. But when we look at that data, some of the things that jump out at us when we have the conversation with the founder, it's the transparency. And right, you'll see all kinds of crazy things in which you see money moving out at a certain periods of the bank account, and they don't disclose. And then when you push on it, right, it's, oh, there, I have a subsidiary that my cousin runs, and money goes there, and like, well, that's why weren't you forthcoming with that? Or oh, I lent the business originally when we started $100,000, but and so that money's coming out, and that's going to another bank account. So anyway, so that lack of transparency, I think, on some things that in many cases could be valid things, right? It's like, I'm repaying myself for a loan to the business or something. But when folks are not forthcoming with that or transparent with that, then it makes you doubt any number that you see and what else is hidden there.
Amazing. We have two more questions.
Just to pick up a little bit on what Carlos said, I think it's, whether you're talking about financials or whether you're talking about another metric like team churn, you should expect that you want to control the narrative, and you do not want the investor to be surprised. Right? Just like investors don't want to be surprised by growth that doesn't meet their expectations or customer churn that surprises them, they don't want to be surprised about something that you could reasonably have framed for them. Right? My CTO and I didn't necessarily get along. You'll see in the last deck, I had a different CTO. We've hired someone with skills that we think are a better match. You want to be able to have the opportunity to control that narrative. And to your point, Carlos, there are situations that change is a natural element, and it can be completely appropriate. And it is much easier for an investor to accept if there is that upfront transparency around why this change has occurred, or why this behavior that might look a little funny is present. And I think that prevents investors from getting surprised, getting concerned, and then going to a very different mode in which everything that surprises them becomes a cause of concern.
Excellent. Okay, let's do the last two questions. One for Whitney and one for Carlos. Let's start with Carlos. Carlos, George Pereira, a member of Angeles Investors, is asking, how do you trade off short-term decisions for revenue generation versus a move away from their long-term objective of these companies when they are just starting out?
Yeah, so on our case, again, we look at the picture a little bit simpler, which is we are trying to make sure we're not trying to figure out where this company is going to be 10 years down the road, kind of that long-term view that most VCs are going to have. But we're looking at a shorter view, which is, okay, what is the viability of this company over the next 24 months approximately, right? And so what we're trying to get is a high level of confidence within that. So we're looking really at the data behind us as the facts, right? And so in that sense, we're hoping that the founder is making the right decisions for the business longevity, really. And so that trade-off should be consistent for the mission of the business, right? So if I'm making a decision that I'm not gonna, one of the things that we see, one of the biggest challenges we see on our end consistently is founders that their revenue expectations don't meet their optimism, but they don't make the adjustment, they don't make the hard decisions fast enough, right? And they get in trouble because they think that, some customers are going to come that they have in the funnel, but it's a long shot, or they get so optimistic about their fundraising capabilities and they said, don't worry about our burn. We're talking to several VCs that are interested and they're going to invest, right? And when those things don't materialize, instead of having been cutting their costs in case some of those things don't translate, they get in trouble. So those are the places in which, I would call those, I guess, near-term decisions, right? That in many cases we see where most of the challenges are. It's not on the kind of the long-term trade-offs. So that's what we generally say.
Yeah, no, I like to add up a little bit into what you mentioned, and is you gotta stick to your mission. At the end of the day, it's like, okay, what values, what mission, what am I bringing, what's my objective, as a founder, and if I have investors, what are my investor objective? Because Whitney mentioned, you become the owner of their ownership as well, and to that, you gotta be careful because we're in an epoch in an industry that every day businesses are being disrupted, and how the trends are going. From one day, a big player like Google can come up with a new tool for the AR model, and you can be without business, right? And it's okay. How do I uh, trade off my idea for the future? And how do I pivot? And sometimes it's about how do I pivot correctly, keeping close my values in my mission, right? The last question, Whitney, is to you, and it's from Ernesto Villarini, another member of Angeles Investors, who's asking, how do you approach bridge financing in startups?
Thanks, Ernesto. I think it's a great question because it is its own category. And the reality is that capital and cash is oxygen, right? These companies want and need to survive, often because they benefit communities or they bring technologies to the market that can be transformative. And bridge financing is not uncommon, right? There are situations in which that's appropriate. I think the first question is, what are you building a bridge to? Right? I mean, nobody wants to build a bridge to nowhere, and no investor intends to build that bridge. Are we building a bridge to profitability? Are we building a bridge to the next round? Are we building a bridge to something that's just going to be a large payment from a customer? And I think we've participated in bridges of all of those types, where what we're really doing is just solving a working capital problem because there's a big incoming customer payment. There are situations where we're building a bridge to the next financing round. And we need to make sure that what we're doing is going to align to how that next financing round is going to work, right? We can't, if we're building a bridge, it can't be incompatible with where we want the destination to be. And then there are situations where we're building a bridge to profitability. And that can look very different, right? That can potentially look like debt. Often that doesn't work as a bridge to the next equity round. So I think the first question to answer around every bridge financing is, what are we building a bridge to? The second would be, what happens if I need two of these, right? Often people don't plan for a bridge financing. They reach a point in their market or in their customer base or in their company's evolution where they need a bridge financing. Thinking about what happens if I have to do this twice. The capital markets are tragically not something that any one company can control. And so thinking about trying to make sure that I've done something that if I needed to do it twice, I could, or if I needed to do something similar again, I could, can be very helpful. Or simply being honest with yourself and your investors that this is a one-time only deal. I've got to do this once and I've got to make it work on the other side. That's okay. Those are situations that do arise, and we've seen companies make that choice and be successful on the other side. But knowing where am I going to, and if I have to do this again, what does it mean? Those can be very helpful in terms of having a good dialogue with your current investors as well as your prospective bridge investors.
Amazing.
And Jeshua, to that note, if I might just add, that's one of the most common use cases for our capital, either because founders just need a smaller amount, or they're trying to get to their next equity round. But as Whitney said, is having that understanding of where they're going and being realistic with that option, right? If I'm growing 25% year over year and saying, hey, this is going to get me to my next to my Series A, I'm like, probably not, right? So I think that's one of the key things, is just be intellectually honest with yourself and where you're at and what are the real instruments that are going to be available to you.
Amazing. Amazing. Thank you, Whitney and Carlos, for this practical and insight conversation. I want to leave everyone with a couple key takeaways, and it's one of them is that startup financials are not just about growth, but about quality, durability, and efficiency. So think those three things when you're taking a look into the financials of a startup. The second one, not all growth is good growth. The underlying economics matter. Take a look into your retention. Take a look into how many cash you're burning. Take a look into those. And the third one is that another point that we highlighted was that metrics are not just for reporting. They shape capital strategy and investor confidence. They build the criteria and the pathway that you need to take a look. If you, as we were just mentioning, if you gotta do a pivot, or if you want to invest and want to raise capital in the next 3 4 years, what's the path that takes you there? And with that, I'll thank again our both of our speakers, the audience, and thank you everyone.
Thank you, Joshua, for
And
having
thank you.
us.
Thank you for convening this really important discussion. And thank you for moderating, Jeshua.